Today, we're looking at a collision of two just unimaginable numbers. I mean, a $230 billion financial cliff and a 5-gigawatt energy wall.
Right. And on one side, you have an entire global industry that is just desperate to buy its way out of extinction.
Yeah, and on the other side, you have a tech sector building physical infrastructure that's so massive and so incredibly power-hungry that it's literally forcing the revival of nuclear reactors.
Exactly. And those two forces, they're not operating in isolation anymore. I mean, they are actively plugging into each other as we speak.
Welcome to the Deep Dive. It is March 18th, 2026, and today we have a massive stack of sources on the desk. We're talking market intelligence reports, corporate filings, phase 1 clinical trial data, and regulatory blueprints.
Yeah, it's a lot of paper today.
It really is. And our mission is to synthesize all of this so you can understand a profound global shift. Because if the early 2020s were defined by this, like, nuclear financial...
So capital was super tight, right?
Right, where capital was tight, and we just had these theoretical debates about emerging tech. Well, that winter has officially thawed. We are analyzing the global market's definitive transition into the era of execution.
The theoretical phase is entirely over. We are now witnessing a synchronized industrial-scale deployment of infrastructure. And that's across AI, biotech, fintech, digital assets. We aren't just drawing blueprints anymore. The market is pouring millions of tons of concrete.
Okay, let's unpack this, because the dots we're going to connect today, they might seem completely disparate at first glance.
Oh, absolutely.
But we're going to show you how trillion-dollar AI pledges are the direct lifeline for that $230 billion pharmaceutical patent cliff we just mentioned.
Yeah.
And we're going to look at how this entire cross-sector convergence is suddenly being lubricated by unprecedented institutional-grade regulatory clarity in the financial system.
But to understand the sheer scale of this execution phase, you really have to start with the physical engine that's driving the global market right now, because you just cannot execute on a global autonomous scale without the foundational compute power to support it.
Right. So let's start with the supplier of that compute power.
Yeah.
Let's look at NVIDIA's monumental goal. Based on the corporate filings we are analyzing today, NVIDIA is aiming to achieve $1 trillion in revenue over the next 7 quarters.
Which is, I mean, let's break down the brutal math behind that ambition.
Please do, because it's staggering.
It really is. To hit $1 trillion in 7 quarters, NVIDIA has to average roughly $143 billion per quarter.
Wow.
And when you consider their previous historical benchmarks were, hovering around the $68 to $70 billion mark, they essentially need to add about $65 billion in net new revenue every 3 months.
Which is the equivalent of adding the entire annual sales of a giant like Amazon Web Services or AMD to their balance sheet every single quarter.
Every single quarter, yes.
Yeah. It's a growth curve that just completely strains comprehension.
Yeah.
But the sources point out that this is entirely tethered to what analysts are calling a $1.8 trillion AI infrastructure supercycle. So where is all of this capital actually going?
Well, it's going into physical gigawatt-scale AI factories. Take the newly announced partnership between NVIDIA and the Nebius Group.
Right.
This is a $2 billion initial investment where they are aiming to deploy over 5 gigawatts of capacity by the end of 2030. And they're specifically utilizing NVIDIA's new Rubin platform and the Vera CPUs.
And just to pause on that, 5 gigawatts is not a traditional data center.
No, not at all.
That is the baseline power consumption of a major metropolis,
Yeah.
dedicated entirely to compute.
Exactly. And the demand side of that equation is just as staggering. I mean, we're looking at the newly expanded Meta and Nebius AI infrastructure deal, which scales up to $27 billion over 5 years.
$27 billion.
Yeah.
And I want to pause here to address the broader wave of domestic investments we are seeing in the U.S. markets right now. Because we have Project Stargate's $500 billion push. We have Meta's $600 billion infrastructure pledge. We have NVIDIA's own $500 billion domestic pledge for supercomputers.
It's a wall of money.
It is. And look, I need to make this very clear for you listening. We're taking absolutely no political sides here. Whether you support the current administration's policies or you don't, we are strictly looking at these numbers impartially as factual corporate capital expenditures.
Right. The numbers are just the numbers.
Exactly. We are simply tracking where the capital is flowing, and right now, hundreds of billions are being locked into domestic physical infrastructure to fuel this boom.
And the underlying reason for this massive capital expenditure, the reason they need all this hardware, is that the fundamental nature of artificial intelligence has shifted. We have transitioned out of the era of generative AI and into the era of agentic AI.
Okay, walk us through that distinction, because the hardware requirements clearly reflect a massive leap in capability. Like, what makes agentic so much heavier?
Well, generative AI, the chatbots we've all been using for the last few years, it's episodic.
Okay.
You prompt the system, it generates an output, and then it goes dormant. It literally waits for human intervention. But agentic AI is autonomous and continuous. We are no longer building systems that just draft an email. We are building AI agents that execute complex, multi-step workflows on their own.
Right, so it's not waiting around.
Exactly. Imagine an autonomous agent deployed within a massive logistics company. It doesn't just analyze the supply chain bottleneck. It identifies the bottleneck, autonomously renegotiates a contract with a backup supplier, provisions the cloud space to run predictive models on shipping routes, executes the financial transaction to pay the new supplier, and then updates the corporate ledger.
Wow. All of that without a person involved.
All in real time, 24/7, without a human ever clicking approve. And that level of continuous background processing requires the Rubin and Vera architectures because they eliminate the memory bandwidth bottlenecks that plagued older chips. You just need constant, uninterrupted compute power.
I hear the theory, I really do, but I have to push back on the physical reality of this.
Okay, sure.
Are we building the world's biggest transcontinental railroad before we even know what the freight is going to be? I mean, we're laying down trillions of dollars of tracks, but there's a massive constraint here, right?
Yeah.
The nuclear AI bottleneck.
Yeah, the power grid.
Exactly. Our sources highlight a $6 billion push for dedicated nuclear reactors just to power these specific clusters. These companies are literally funding the revival of nuclear power because agentic AI is that thirsty.
It is.
It just seems like a massive risk to build cities of compute power when the grid itself is buckling.
Look, you're not wrong. The energy bottleneck is absolutely the defining constraint of this decade. The market narrative of infinite software scalability is violently colliding with the physical reality of the power grid. But to address your pushback about the freight, like what is actually going to run on these multi-trillion-dollar tracks,
Right.
you just have to look at the industries that are facing existential threats. The first sector to truly weaponize this gigawatt compute power isn't logistics or consumer tech, it is biotechnology.
And this is where the macroeconomic dots connect perfectly. Because just as the tech sector is hitting a physical energy wall, the pharmaceutical industry is hitting a massive financial wall.
Yeah, a wall of their own making.
Let's look at the $230 billion patent cliff. And actually, some of the intelligence reports we have today push that estimate closer to $236 billion.
That's a staggering amount of revenue at risk.
Between 2026 and 2030, the foundational patents for some of the world's most profitable therapies are expiring.
And to fully grasp the panic in the boardrooms of big pharma right now, we really need to look at the mechanics of patent erosion, because it's unique to this industry.
How so?
Well, when a tech company releases a product, its revenue might slowly decline as competitors iterate, right? But in pharmaceuticals, when a blockbuster drug loses market exclusivity, it is not a slow decline, it is a cliff.
It falls right off.
The second generic competitors enter the market, the price erosion is immediate. It often wipes out 80 to 90% of a drug's revenue almost overnight.
Let's ground this in the actual filings on the desk. Merck's blockbuster diabetes drug, Januvia, is facing generic entry right now, literally in May of 2026.
Yep.
Or look at Eliquis, the blood thinner co-marketed by Bristol-Myers Squibb and Pfizer. It has been a foundational standard of care for stroke prevention globally, and its exclusivity threshold is breaking. For some of these pharmaceutical conglomerates, upwards of 60 to 65% of their current global sales are entirely exposed over the next 4 years.
Which triggers an M&A renaissance out of pure survival instinct.
Mergers and acquisitions.
Exactly. If you're a pharma giant staring down the loss of half your revenue, the traditional 10-year timeline for in-house drug discovery is a death sentence. You cannot invent your way out of the patent cliff fast enough.
Right. 10 years is too long.
So you have to buy your way out. You are heavily incentivized to acquire de-risked, clinical stage assets to replenish your pipeline immediately.
And we are seeing that exact strategy play out with Merck. I mean, they've set an incredibly aggressive goal to reach $70 billion in sales by the mid-2030s. They're essentially trying to replace and then double the peak revenue of their flagship cancer drug, Keytruda, before it goes off patent in 2028.
And they're doing it through massive acquisitions, right?
Right, like their buyout of Verona Pharma and the acquisition of Sedora. But the market environment in 2026 is vastly different from previous M&A cycles. Valuations for promising biotech assets are sky high right now, yet human clinical trials remain inherently risky. Big pharma can't just write blank checks anymore. So how are they structuring these deals to protect themselves?
Well, we're seeing the normalization of incredibly complex risk-mitigating deal structures. Take the spin merge as a prime example.
Okay, break that down.
So Novartis recently acquired Avidity Biosciences for $12 billion. But Novartis didn't want Avidity's entire pipeline. They executed a portfolio rationalization. They only wanted the crown jewel neuromuscular RNA therapies.
Okay.
So before the acquisition closed, Avidity spun out its non-core cardiology assets into a completely separate independent company, and then Novartis merged with the remaining entity. It allows the buyer to acquire exactly what they need without carrying the dead weight of research programs they just don't want to fund.
That makes sense. And we're also seeing a massive surge in contingent value rights, or CVRs.
Oh, absolutely.
Look at Roche's $3.5 billion buyout of 89bio. A CVR is essentially a financial bridge between an optimistic biotech founder and a risk-averse pharmaceutical buyer.
Right.
Roche is effectively saying, look, we will pay you a massive premium today, but a significant portion of the total buyout price is locked. We will only pay you that remaining $1 billion if the drug actually hits specific clinical endpoints in phase 3 or achieves a certain commercial sales target.
Right. So it forces the acquired company to keep skin in the game. But we really have to look at what these buyers are actually hunting for. Big Pharma knows that the era of simple symptom management drugs, a pill that just masks the pain of a disease, that era is over. To justify these massive multi-billion-dollar price tags, they are desperately seeking disease-modifying therapies.
Here's where it gets really interesting, because this brings us to the front line of that exact battle. Let's pivot to the ADPD 2026 conference happening right now in Copenhagen, the International Conference on Alzheimer's and Parkinson's Diseases.
Yeah, the data coming out of there is incredible.
The data coming out of this conference is exactly what the industry is looking for to replace that $230 billion shortfall. Specifically, Gain Therapeutics just presented Phase 1b data for their lead candidate, GT02287, aimed at Parkinson's disease.
And to understand why this is making such waves, we need to dive into the biology a bit.
Yeah, please. We know that Parkinson's is frequently associated with mutations in the GBA1 gene. But what is that gene actually doing, and why has it been so difficult to target historically?
Let's break down the cellular mechanics. So in a healthy human brain, the GBA1 gene is responsible for producing an enzyme called GCase.
Oh, a GCase, right.
Think of the GCase enzyme as a microscopic garbage disposal inside your brain cells, specifically within the lysosomes. Its entire job is to break down complex, toxic cellular waste, primarily a lipid called GLUF.
So it just clears out the trash.
Exactly, but when a patient has a GBA1 mutation, the GCase enzyme they produce is misfolded. Because it's the wrong shape, the garbage disposal just stops working. The toxic GLUS lipids build up, they literally choke the neuron, and eventually the brain cell dies.
Wow.
And that progressive cell death is what causes the severe motor and cognitive decline in Parkinson's. Now, historically, the pharmaceutical industry tried to treat Parkinson's by simply replacing the dopamine that the dying cells were no longer producing.
Right, just treating the symptom.
Exactly. It managed the tremors, but the cells kept dying anyway.
So how does GT02287 actually intervene? Because the data shows they aren't just treating symptoms, they are going after the root cause.
Right. So GT02287 is what we call an allosteric enzyme modulator. It doesn't try to replace the enzyme, and it doesn't try to clear the garbage directly itself. If you imagine that misfolded GCase enzyme as a crumpled up paper ball, this drug acts like a microscopic origami master. It physically binds to the crumpled enzyme and forces it back into the correct functional shape of a paper airplane.
That is a great analogy.
Thanks. By restoring the shape of the enzyme, the garbage disposal turns back on, it clears out the toxic lipids, and the neuron survives. It is fundamentally disease-modifying.
The clinical data they presented in Copenhagen backs up that mechanism. In just 90 days of dosing in human patients, they demonstrated clear target engagement in the central nervous system. They successfully reduced that toxic lipid buildup, bringing the GLUS biomarker back down to healthy baseline levels.
In 90 days, that's so fast.
It is, but what is truly historically rare is that they saw early signs of clinical improvement, or at least stabilization, in the MDS-UPDRS scores within that same 90-day window.
Right.
And for you listening, that is the Universal Clinical Rating Scale for motor and non-motor symptoms in Parkinson's. To see a statistical signal that the patient's actual physical movements are stabilizing after just 3 months of a Phase 1b trial is, well, it's practically unheard of in neurodegeneration.
It completely upends the traditional timeline for evaluating neurological drugs. And Gain Therapeutics isn't the only one pushing the envelope in Copenhagen. I mean, Lundbeck is also presenting Phase 1b data for LuA-F28996, which is a highly targeted D1D2 receptor agonist designed specifically to smooth out the severe motor fluctuations in advanced Parkinson's patients.
But let's bring this back to the macro scale. We have Big Pharma desperate for these disease-modifying breakthroughs. But traditional drug discovery, finding that origami master to fix a specific crumpled protein, that takes a decade.
Usually, yes.
They don't have a decade before the patent cliff hits. How do they compress a 10-year timeline into a 2-year timeline?
Well, this is where the convergence happens. By directly plugging those 5-gigawatt AI factories we talked about earlier into their R&D pipelines. The intersection of high-performance compute and molecular biology is literally the only way to beat the patent cliff.
I see the connection, but explain the mechanics for me. How exactly does a massive cluster of Vera CPUs in a Nebius data center actually discover a drug like GT02287?
It all comes down to simulation. Look, a human protein is an incredibly complex 3D structure. Finding a small molecule that can bind perfectly to a misfolded pocket on an enzyme is mathematically staggering.
Like finding a needle in a haystack.
Worse. In the past, scientists had to synthesize thousands of compounds in a physical lab and test them one by one in petri dishes. It was blind trial and error. But today, AI models trained on vast data sets of quantum chemistry and structural biology, they can simulate millions of molecular interactions in seconds. The AI factory can mathematically model the exact 3D structure of the mutated GCase enzyme, design a bespoke allosteric modulator that fits perfectly into the binding pocket, and predict its toxicity and efficacy before a single chemical is ever mixed in a physical lab. The compute power just replaces the physical trial and error.
And we are also seeing a massive shift in how this hyper-accelerated research is actually funded and organized.
Yeah.
Because the sources are pointing heavily to the rise of decentralized science, or DESI, and specifically the deployment of bio-DAOs.
Yes.
We're talking about decentralized autonomous organizations focused entirely on funding biology.
And this is a direct response to the massive inefficiencies in traditional venture capital. Because historically, if a brilliant researcher at a university wanted to develop a cure for an ultra-rare disease, they had to spend years pitching VCs. And if the patient population was too small, meaning the potential profit was too low, the VCs would pass and the science would literally just die in the lab.
So how does DESI fix that?
DESI bypasses that entirely by using blockchain technology to fractionalize the ownership of scientific intellectual property. They use what are called IP NFTs.
Walk us through a concrete scenario of how an IP NFT actually works for a patient. Like, how does money move?
Okay, imagine a global patient advocacy group for a rare genetic disorder. Instead of begging a pharmaceutical company to care about them, the patients, along with independent researchers and crypto investors, pool their funds into a transparent smart contract governed by a bio-DAO.
Okay, they crowdfunded essentially.
Right. That bio-DAO directly funds a lab to research the cure. In exchange, the legal rights to the resulting patent are minted on the blockchain as an IP NFT, and ownership is distributed proportionally to everyone who contributed. Yeah. So if that research yields a viable drug, and a massive pharma company buys the rights to it, the royalties are automatically and instantly routed back to the wallets of the patients and researchers who funded it. It totally democratizes the monetization of science.
Okay, I have to step in and push back on this entire AI-accelerated, decentralized model.
Go for it.
It sounds like a techno-utopian dream. But let's look at the reality of biological data. It is notoriously messy. It is noisy, incomplete, and highly subjective.
That's true.
If we feed flawed, biased, or incomplete biological data into these massive agentic AI models, don't we just run the risk of failing faster and more expensively? Can an autonomous AI agent actually understand the unpredictable, chaotic reality of a human clinical trial?
That's a fair point.
Because a mathematically perfect simulation of a mouse model is not a human being with a complex medical history. Are we just suffering from the garbage in, garbage out problem on a multi-trillion-dollar scale?
It is the most critical risk in the entire DeSci space. And garbage in, garbage out is absolutely a massive threat. But I think you're looking at the AI as a single predictive event rather than an ongoing process. What agentic AI enables is something entirely new: the continuous underwriting of biological risk.
Okay, what does continuous underwriting actually look like in practice?
Historically, clinical trials are episodic and static. You lock in your trial protocol, you run phase 1, you wait a year for a document-heavy analysis by a committee, and then maybe you run phase 2.
Lots of waiting.
Right. Agentic AI moves us away from that static model. It allows for real-time biological modeling. An autonomous agent can continuously ingest real-world patient data from wearable sensors, updated genomic sequencing databases, and electronic health records globally.
So it's always updating.
Yes. As new data comes in, the AI dynamically adjusts the probabilities of the drug of success. It can spot a microsignal of liver toxicity in a specific genetic subpopulation months before a human doctor would notice it in the aggregate data.
That's incredible.
Right. It doesn't replace the chaotic reality of the human trial. It acts as an omnipresent risk manager, drastically narrowing the margin of error, shrinking the haystack before you ever start looking for the needle.
So the science is moving at the speed of light. We're using gigawatt compute to discover drugs and decentralized networks to fund them globally. But there is a fatal flaw in this entire biotech renaissance.
Which is?
The money. You can use an AI factory in Texas to design a breakthrough drug for Parkinson's, and a bio-DAO with members in 40 different countries can fund the IP. But if you actually want to deploy that drug to billions of patients globally, pay the decentralized royalties, and manage cross-border medical supply chains, the traditional banking system is entirely unequipped for it.
It really is.
The science is moving at the speed of light, but the money is moving at the speed of a 1970s swift wire transfer.
Exactly. The geographical friction of legacy finance is the biggest bottleneck to the era of execution, which is exactly why we are seeing a parallel build-out of a completely new financial rail, specifically originating in Asia right now.
Let's look at what is happening right now in the Greater Bay Area, the GBA. The intelligence reports highlight the deployment of the 5 Connection system. This is a massive initiative fundamentally integrating cross-border healthcare and finance between the Hong Kong, SAR, Macau, and the mainland Guangdong province.
Yeah, it's a huge test case.
It is. Let me give you a specific example from the sources. Right now, senior citizens residing in Hong Kong can take their digital financial health vouchers, cross the border into Shenzhen on the mainland, and seamlessly use those digital vouchers to pay for medical treatment in mainland clinics.
And, on the surface, paying for a doctor's visit sounds simple, but the back-end complexity of that transaction is just immense.
Like with the different systems.
Exactly. You're taking 2 entirely different jurisdictions with different currencies, different privacy laws, and different medical regulatory frameworks, and you are synchronizing them instantly. The 5 Connection system is securely verifying the patient's identity, translating their medical records across borders, converting the value of the health voucher, and settling the cross-border payment to the mainland clinic in real time. It is essentially a regional testbed for the future of global medical commerce.
And to lubricate that kind of instant cross-border commerce on a global scale, you need a new kind of money. Which leads us to the major fintech bombshell of this deep dive. Hong Kong is officially issuing its first stablecoin licenses.
Huge news.
And they aren't issuing them to scrappy crypto startups. They're issuing them to massive traditional note-issuing banks, HSBC and Standard Chartered.
We all know that stablecoins have dominated the retail crypto markets for years as a way for traders to park cash. But you have to look at the implications of this specific news.
Yeah, tell us what this means.
What happens when legacy juggernauts like HSBC and Standard Chartered, the very banks that currently underwrite massive portions of global shipping and trade finance, what happens when they actually get licensed to issue programmable stablecoins?
It changes everything.
It does. That is not a fringe crypto experiment anymore. That is the Wholesale institutional replacement of the SWIFT network.
It is the institutionalization of digital money. The Hong Kong Monetary Authority, the HKMA, is pushing this aggressively. They have also signed a memorandum of understanding with Shanghai to develop a shared blockchain platform specifically for cargo trade and finance. They are taking the massive logistical data of mainland China's cargo shipping and integrating it directly with international blockchain-based financial systems.
And then you look at Project Ensemble.
Yes, exactly.
This is the HKMA's live interbank pilot program, and they have brought in absolute heavyweights. We are talking about BlackRock and Ant International actively testing the settlement of tokenized real-world assets using wholesale central bank digital currencies and these newly licensed stablecoins.
The plumbing of the global economy is being ripped out and replaced with fiber optics. But there's a massive caveat here.
Always is.
Institutions like BlackRock, HSBC, and Standard Chartered will not pour billions of dollars of concrete on unstable legal ground. You cannot have global banks issuing stablecoins without absolute regulatory clarity in the West.
Which brings us directly to the seismic shifts happening in U.S. financial regulation. Capital will flow where it is treated best, and the U.S. has finally realized it was losing the execution race. So, welcome to the Atkins era at the Securities and Exchange Commission.
The SEC.
Right. Under SEC Chair Paul Atkins, the era of regulation by enforcement, where the SEC simply sued digital asset companies after the fact without providing clear rules beforehand, that era is officially over.
Thank goodness.
Yeah. We are seeing a historic joint effort between the SEC and the Commodity Futures Trading Commission, the CFTC, to finally categorize digital assets definitively. They've introduced a comprehensive 5-category classification system. This is the foundational rulebook for the next decade of digital finance.
Let's walk through these 5 categories, because understanding this taxonomy is absolutely crucial for understanding where institutional capital is moving right now.
Sure.
So, Category 1, digital securities. If the token acts like a traditional investment contract representing equity or a promise of future profits from a central enterprise, it is a security, regulated strictly by the SEC.
Makes sense. And Category 2 is digital commodities. This is where fully decentralized assets, primarily Bitcoin and Ethereum, are housed. Because there is no central issuer controlling them, they are classified as commodities and fall under the oversight of the CFTC.
Right. Category 3, digital tools. These are tokens used purely for network utility. You use the token to access a specific software service, not as an investment to hold for profit.
Then Category 4 covers exactly what we just discussed in Hong Kong, stablecoins. These are recognized as distinct payment instruments, not speculative securities, requiring their own specific framework for reserve audits and redemption rights.
And finally, Category 5, digital collectibles. These are non-security digital assets, primarily encompassing the majority of NFTs, where the value is derived from artistic or collectible merit rather than financial yield.
And alongside this 5-category taxonomy, Chair Atkins is pushing a massive structural reform known as the Safe Harbor proposal.
This is huge.
It is. The industry is referring to it as the Regulation I paradigm shift, I standing for innovation.
So what does that actually mean for a startup?
It's a fit-for-purpose startup exemption. It allows blockchain innovators and entrepreneurs to apply for a bespoke pathway to raise capital and operate their networks for a set period of time, say 3 years, without facing immediate paralyzing enforcement actions from the SEC.
So they get a runway.
Exactly. It gives them the legal breathing room to actually build out the decentralized utility of their network before being judged on whether it is a security.
I look at this 5-category system in the Safe Harbor like the creation of the Dewey Decimal System for a massive chaotic library.
Oh, that's a good way to put it.
Because for the last 10 years, digital assets were just a giant pile of books dumped in the center of the room.
Yeah.
The regulators kept walking in, looking at the pile, and saying, we don't know what these books are, so nobody is allowed to read them. And if you tried to pick one up, you got sued.
Right. It was just total chaos.
But now, finally, there's a specific shelf for every single type of digital asset.
Yeah.
And because the library is finally organized and the rules are clear, massive institutional money finally has the confidence to walk in, pull up a chair, and start deploying capital.
And we are seeing the immediate, undeniable market impact of that institutional confidence. Look at the price action of Category 2 assets. Bitcoin has been hovering strongly around the $74,000 mark.
Despite the macroeconomic headwinds.
Exactly. What is remarkable isn't just the price, but the resilience. Even amidst intense global geopolitical tensions and the Federal Open Market Committee signaling rate hold expectations, which historically would just crush risk assets. Bitcoin isn't panicking. The market is consolidating at all-time highs.
Because the buyers aren't retail day traders anymore. It is all institutional infrastructure moves. Look at MicroStrategy, which is officially rebranded as Strategy Inc., to reflect its evolution from a software company into a Bitcoin development company.
Oh yeah, their buying spree is wild.
The filings show they accumulated 22,337 Bitcoin in a single week in March. That is over $1.5 billion deployed in a matter of days.
And then look at traditional finance moving on-chain. BlackRock's tokenized treasury fund, known as BUIDL, just surpassed $2 billion in assets under management. They are taking U.S. treasuries, tokenizing them on a public blockchain, and offering them to institutional clients.
They're building the plumbing for a tokenized global economy. So if we look at the macro picture we've painted so far, we have trillion-dollar tech giants building physical gigawatt AI factories. We have global pharmaceutical conglomerates using AI to acquire biotech innovators to survive a $230 billion patent cliff. And we have massive global banks and asset managers leveraging crystal-clear SEC regulations to digitize the very nature of money.
It's a lot to take in.
So what does this all mean? Which brings us to a critical question. We're talking about trillion-dollar macro trends, but what does this all mean for the rest of the economy? How does this era of execution actually impact the small and medium-sized enterprises, the SMEs, that make up 90% of global businesses?
Right, because most businesses aren't building gigawatt data centers.
Exactly, because let's be honest, the local logistics company or the mid-sized manufacturing plant isn't building a 5-gigawatt data center, and they aren't curing Parkinson's disease. How does this convergence trickle down to Main Street?
For the 90% of businesses out there, this era is defined by the rapid rise of invisible banking. The fundamental concept of a standalone bank as a destination that a business owner goes to, whether that is a physical branch on a corner or a separate clunky web portal, is vanishing entirely.
Let's look at the mechanics of this through a fintech company highlighted in reports called Gemba. They are pioneering what they call a 7-minute deployment standard.
Which is just, it's incredibly fast.
It's mind-blowing. What that practically means is that a specialized software company, let's say a software-as-a-service platform that manages inventory and dispatch for thousands of independent plumbing contractors, they can now spin up fully compliant, white-labeled banking infrastructure directly inside their own app in under 7 minutes.
And the efficiency gain here is staggering. Historically, if that plumbing software company wanted to offer checking accounts or issue branded debit cards to its users, it required 12 to 18 months of grueling software development.
Yeah, you had to build a bank from scratch.
Right. They had to endure massive security audits, negotiate complex legal agreements with legacy sponsor banks, and build custom API rails. Now, via platforms like Gemba, banking is reduced to a simple plug-and-play feature. The financial services are embedded directly into the software workflows that business owners are already using to run their daily operations.
And when you embed banking into operational software, it fundamentally changes how credit is underwritten and accessed. Our sources highlight a tool called the Credit Compass, developed by the SME lender Iwoka.
Right, and they frame this with a truly shocking statistic.
Share it, because it floored me.
51% of UK SME owners lack a solid grasp of their own financial standing. Over half of the businesses powering the economy do not understand their business credit score, they don't know how to improve it, and frankly, they don't trust the traditional credit agencies that generate it.
And that lack of transparency is incredibly dangerous, especially when navigating a volatile, high-interest rate economy. The legacy credit system is a black box. A business owner applies for a loan, a human loan officer looks at lagging indicators from a static quarterly report, and weeks later, a decision is rendered with little explanation.
A Credit Compass completely dismantles that black box. It integrates traditional Equifax credit scores, official corporate filings from Companies House, and real-time cash flow data via open banking APIs, and synthesizes it all into a single, highly readable dashboard.
It shifts the business owner from passive observation to proactive credit management. Instead of just waiting to see if they're approved or denied, the AI within the Credit Compass provides plain English explanations of exactly what factors are dragging their score down and give them actionable step-by-step instructions on how to improve it before they even apply for the loan.
And if you take that a step further, you see the ultimate endpoint of invisible banking. AI and open banking are shifting credit from a static quarterly score to a real-time, continuously monitored lifeline.
How does that work in real time?
Well, if you are an SME utilizing an embedded banking platform, the software already knows your real-time inventory levels. It knows your accounts receivable. It knows your historical cash flow cyclicality.
Right.
Because agentic AI is continuously underwriting your business risk in the background, it can autonomously offer you a bespoke line of credit the exact moment you need it to cover a supply chain gap, embedded seamlessly into your workflow without a single human loan officer ever reviewing a document.
So let me make sure I am fully grasping the gravity of this across the board. We are fundamentally eliminating the friction of waiting.
That's a great way to summarize it.
We started by looking at NVIDIA pouring concrete for physical gigawatt AI factories because agentic AI can't wait for human prompts. It needs continuous compute to run autonomous workflows. We navigated the pharmaceutical industry's desperate multi-billion-dollar race to beat a $230 billion patent cliff, where they are using that AI to continuously underwrite biological risk, effectively eliminating the trial and error waiting period of drug discovery.
Yep, solving the time problem.
And we unpacked the regulatory frameworks, from the SEC's 5 categories to Hong Kong's stablecoin licenses, that are finally replacing the slow geographic friction of the legacy banking system with instantaneous invisible financial rails for both global institutions and local SMEs.
That is the exact through line here. The defining characteristic of the era of execution is the total collapse of operational latency. The foundational tools, the compute, the biological models, the regulatory frameworks, the digital money are now fully built and legally sound. The blueprints are approved, the concrete is poured.
It's all happening right now.
It is. The next phase is entirely about how operators, investors, and you, the learner, choose to use these tools to build the future.
And as we wrap up, I want to leave you with one final, mind-bending concept to mull over on your own. It is something we have only begun to scratch the surface of today. We talked extensively about agentic AI, and we talked extensively about programmable, institutional stablecoins. Think about the inevitable convergence of those two technologies.
Oh, wow.
We are rapidly approaching an era that analysts call the 24/7 liquidity mesh.
That sounds like science fiction.
It does, but imagine a world in the very near future where AI agents are granted autonomous control over corporate treasuries. They aren't just drafting supply chain emails. They are executing millions of cross-border stablecoin settlements a minute to arbitrage currency fluctuations. They are automatically deploying fractional capital to decentralized BioDAOS. The second, a real-time clinical trial data stream, shows a positive biomarker reduction.
Completely autonomous finance.
Exactly. At what point does human decision-making, waiting for an investment committee to meet on a Thursday, or waiting for a correspondent bank to open on a Monday morning, at what point do we become the slowest, most outdated bottleneck in our own global economy?
That is a fascinating question to leave on.
When the concrete is finally dry on this multi-trillion-dollar infrastructure, it's not just the buildings and data centers that will look different. It is the fundamental speed of the reality happening inside them. Thanks for diving deep with us today.